Welcome to our group project presentations, and these are our team members and the team contracts. And this is our table of content. So moving up to our very first part is introductions. The missions of this presentation is to analyze how exchange rate fluctuations affect Central Hydropower Joint Stock Company (CHP) in Vietnam, and we will provide recommendations based on the findings. Deeper into the company and the numbers, or we will explain you what are the exchange rates and how do they affect the company. So currency exchange rates represent the value of one country's currency relative to another and play a key role in international economic activity. For business, fluctuations in exchange rates are a major source of financial risk. Changes in currency values can directly impact operating costs, financing expenses, and overall profitability. As a result, understanding and managing exchange rate movements is essential for maintaining financial stability and performance.
The company that we chose to analyze is a Central Hydropower Joint Stock Company, CHP for short, which is a utility company based in Vietnam. Its job is producing electricity and selling it to the national power grid. The firm also has equities nationwide in renewable projects, as well as being in the forefront for financing long term energy infrastructures. As a business, volatility in the exchange market affects the firm in various ways, and these are the three variables that we chose to highlight in our presentation. The first variable affected is COGS, the cost of goods sold. In theory, if there's fluctuations of the FX market, there's a direct impact on costs. This is especially true for companies that are heavily reliant on foreign imported goods for production and maintenance, as these goods are acquired in the foreign currency. And this covers anything from mechanical parts such as turbines and generators all the way to servicing. Imported goods will see an inverse increase in price, domestic price, if the VND depreciates. And this is a phenomenon known as transaction exposure. For companies like CHP, the reason why this is significant is because utilities that are highly specialized are niche, and sourcing them from alternatives can be especially hard. FX links costs cannot be offset if the tariffs changes, making businesses that import these foreign goods very sensitive to exchange rate fluctuations. Interest expense is the other variable that we looked into. Utility companies in general are very capital intensive and require funding from long-term investors. Loans dealt in foreign currencies are really sought after if the interest rates are low. However, when interest rates are high and the VND depreciates, the interest maintains. However, it's more expensive in the domestic currency, increasing the price that firms have to pay in general. This is important for CHP as FX shocks instantly translate into expense. And since services sold are done in VND at a fixed pricing, it is very difficult to recover as a company and pass this extra cost onto consumers by increasing price in the short term. The third variable that we chose to look at is revenue. CHP earns their revenue in VND by selling electricity domestically. FX volatility has a massive impact on capital earned as tariffs have to be adjusted to compensate for pricing fluctuations of imported goods. And this is all done to maintain financial stability. Real revenue is also lowered in the face of inflation and affects the market demands for electricity. For CHP, this variable is significant because of its downstream effects on regulating viable market prices to keep up with costs. Long-term depreciation of the VND will also ultimately affect the hydropower utility company's cash flow and capital investments, as well as potentially hindering their competitiveness in the foreign markets in the future.
Next, we'll take a look at the data and the descriptive statistics. Here is a quick overview of the raw data used for the analysis. The data was gathered directly from the Ho Chi Minh Stock Exchange website. 15 quarterly financial statements were gathered. Unfortunately, many statements were missing. Thus, perfectly chronological data could not be gathered, as seen in the large gaps in the data, with 2022 missing and large parts of 2023. The monthly exchange rate for the USD VND over the period were gathered and then used to calculate the corresponding quarterly value by averaging the mean from the corresponding quarterly months. Analysis of the descriptive statistics highlights some interesting findings. The cost of goods sold had a modest standard deviation of about 18.3 compared to its 93.4 billion VND mean, suggesting costs were relatively stable. The interest expense has a high standard deviation, suggesting major changes in the firm's financing structure. The revenue's high standard deviation can be attributed to a very low revenue in 2021, which acts like an outlier. The exchange statistics show a stable relationship with low standard deviations and a tight minimum and maximum value, highlighting a trend of gradual weakening and not of sudden fluctuations. Next, we'll look at visualizations and data trends. First, we'll examine the exchange rate fluctuations, then we'll look at the revenue levels, then move on to the cost of goods sold, and finally look at the interest rate expense changes. The first visualization aims to paint a picture of the current USD VND exchange rate trends. Before 2021, the VND was appreciating against the dollar. However, past 2021, the dollar strengthened and continues to strengthen. One major explanation for this is the US policy of raising interest rates in an effort to curb the effects of the COVID-19 pandemic on the economy. This visual aims to demonstrate the changes in the company's revenue over the period. A general trend of growth can be seen in the data, with revenue in 2019 being just 100 billion, almost doubling to 200 billion by mid-2020. 2021 first quarter saw a large decrease in revenue, dipping below 50 billion. One possible explanation for this could be due to the COVID-19 disruptions. Since 2021, the company's revenue has only been increasing, with two major spikes in 2023 and 2024, and by 2025, the revenue has been around 200 billion, or twice as much as back was in 2019. COGS is one of the most important variables to compare against the exchange rate. The first visualization aims to highlight cost of goods sold relationship with revenue, and an obvious overlap of peaks is present, which is expected. The second visualization hides a small trend of rising cost of goods sold and the exchange rate, though further analysis is required to find any meaningful connection. The last visualization aims to highlight the company's trend in lowering its interest expenses from around 30 billion in 2019 to around 9 billion by 2025. This can be attributed to potential shifting of financial structure in the company or by its repayment of its debts.
Hi, I'm gonna talk about correlation analysis and simple line regression. Correlation analysis. This correlation matrix show how the key financial variables relate to each other. COGS, interest expense, revenue, and exchange rate. The strongest link is between the COGS and the revenue at 0.96, meaning they move almost in sync. Interest expense has a negative correlation with the exchange rate, about minus 0.95. So when the VND weaken, interest costs tend to go down. The exchange rate also has a moderate positive correlation with the revenue, around 0.59, suggesting that currency depreciation could help boost export sales. So for the regression analysis between revenue and exchange rate, this slide shows how revenue relate to exchange rate. From the scatter plot and the trend line, we can see when the USD or VND rate goes up, the revenue usually increases as well. The R square is about 0.35, which means roughly 1/3 of the changes in revenue can explain by the exchange rate. Each dot represents 1/4, so the trend is easy to spot. For the regression analysis between the COGS and the exchange rate, this slide here we have the regression of the COGS against the exchange rate. The scatter plots show the rising trend, meaning as the USD or VND rate goes up, the costs tend to increase. The R square is about 0.3, so around 30% of the variation in the COGS is explained by exchange rate. This fits the idea that when the local currency weakens, the cost of import material rises, affect products cost overall. The regression analysis between exchange rate and interest expense. This slide shows how interest expense change with the exchange rate. The scatter plot has a downward trend, which means that when the USD or VND rates go up, interest expense usually goes down. The slope of the line is about minus 9 million, and the R square is very high at 0.9, showing a strong link between two. This probably reflects how currency fluctuation affects the company's foreign debt and interest payment.
So here's the casual analysis regarding how the exchange rate fluctuation impacts central hydrogen power financial stability. So our objective was to quantify exactly how much the financial risk or benefit CSP face when the Vietnamese dong depreciates against the USD. So in this case, we use 95% company level. Here is the revenue versus the exchange rate summary output. So here's the cash analysis of revenue versus the exchange rate. So we found a statistically significant positive correlation between weaker Vietnam dong and the higher revenue. Specifically for our model shows that for every one BND decrease in the exchange rate, so central hydrogen power and revenue actually increased by approximately 49.7 million. So essentially, CSP contract likely index revenue to the USD, allowing CSP top line profit to automatically adjust upward when the currency is weakening. So this is the summary output of cash analysis of COGS versus the exchange rate. Okay, so when we look at cost of goods sold versus the exchange rate, we find a positive correlation. As the exchange rate rises, CSP costs rise. The model predicts that every 1 VND depreciation increase the cost of goods sold by 9.7 million Vietnam dong. This validates that CSP has considerable exposure to import part, input likely machinery or maintenance. So while the company make more money when the Vietnamese dong weaken, it's also caused it to operate more. Okay, so this is the interest expense versus the USD summary output. Okay, so here's the interest expense versus the exchange rate. So our data show that's a negative correlation. So our interest cost actually dropped by 9.3 million VND for every unit increase in the exchange rate. This doesn't mean that currency risk wasn't there, rather it just suggests that during this specific period, CSP was aggressively paying down the principal debt. This repayment masks the negative effect of currency devaluation. Here's our cultural analysis findings. So we are observing a natural hedge. So when the currency weakens, GSP costs go up by roughly 9.7 million, but revenue jump by 49.7 million. The revenue gain completely absorbed the cost inflation. So by matching the currency's sensitivity of GSP inflow with its outflow, GSP have minimized the net economic exposure. So they effectively mean that central hydrogen power is operationally hedged and may not need to spend heavily on the external financial derivative, to be said.
Okay, now moving on to the final part, I propose some recommendations for improvement to the company. First is foreign exchange hedging. Given the empirical findings that exchange rate depreciation significantly increased cost of goods sold, the firm should implement foreign exchange hedging instruments such as forward contracts and currency swaps to hedge predictable USD-denominated input costs. According to analysis and Western firms that actively hedge foreign exchange risk experience lower cash flow volatility and improved firm value. There are many licensed Vietnamese commercial banks such as Vietcombank, BIDV, Vietinbank, or HSBC Vietnam that are available for foreign exchange forward contracts and swaps. By hedging confirmed short-term import payments, for example, 6 to 12 months, the firm can stabilize production costs and protect gross margins from adverse USD BND movements, directly addressing the key risks identified in the analysis. Moving up, my second recommendation is about operational efficiencies. So, to reduce structural exposure to exchange rate fluctuations, the firm should improve operational efficiencies by increasing local sourcings and diversifying suppliers away from USD price imports where feasible. Williamson's wrote that operational hedging, such as sourcing diversifications and flexible procurement, can be as effective as financial hedging in managing exchange rate risk. This approach directly addresses the study findings that costs and revenues are most affected by exchange rate changes. And this is our references. This is the second slide. Thank you for listening to our presentations.